weekend, all. Ira Epstein with your SPDR ETF weekly edition for this July 2nd, 2021. Now, in the weekly, we always cover just the weekly charts. We sometimes start off with a monthly every now and then, but it's mostly weeklies that we're going to go through. The other thing is I want to wish you all a great July 4th. We had what we'll call a Goldilocks number on Friday in the jobs report, just phenomenal. Big, nice number in job growth, not a runaway. Not something that's overly hot. We did not get the labor participation number to budge. That's negative to the market. A little bit of pressure on pricing. You went up a dime an hour. I don't think that's very much in terms of wage inflation. And what it was enough, in my opinion, the trader said is, yeah, the Fed can do the tapering, but if that number today is going to make them raise interest rates, that isn't going to happen. Then you have to look at the break that we had in the lumber markets, other markets, and the raw materials recently to see the story there. Now, admittedly, OPEC has not reached a deal. Oil's at about $75 a barrel now. That's a high price. Will that sap the market? I think there's concerns about that. OPEC wants to go to 400,000 barrel a day increase. The UAE says no, it's not enough. And it's not for 1 month. They want to do this into 2022. I think they want bigger market right now while the market's hot. I think there's a lot of fear on OPEC's part that COVID-19 is so bad that it could slow the economies down again. Well, what's the point of keeping oil prices jammed up that high? You know, everybody's got an interest. They want money now. They weren't earning money. Remember, we were negative $40 this past year. So I won't go into all that. When we take a look at ARK, and we're looking at this, it has been in an uptrend, a pattern of higher lows and higher highs. Now, this brown line is called a swing line. It's in our charting software. It's an indicator I wrote many years ago. It looks to see as the market of the current day making a higher high or a lower low, an inside day or an outside day up or down. Based on that, I've got a set of rules that I teach in my charting course, created the indicator, and that's what I use it for. Then I have what's called an enhanced Bollinger Band course, teaching you how to use the Bollinger Bands from my perspective. It is different than you're probably used to. First time you hit a Bollinger Band, what I teach traders is that's where the smart money comes out of the market. I know you're going to tell me that the market can hit it and it keeps going. Yes, but there's ways with momentum to ride that trend if you're embedded. Embedded means that on the slow stochastic study, the K and the D lines, which are the red and the blue, are going sideways over 80 or sideways under 20 if it's bearish. And when that happens, you're looking on these breaks to be a buyer, and I teach where to do that in that course, and I review it in my morning subscriber video. But suffice to say, here's what I see. An uptrend, you hit the first time you hit the upper Bollinger Band, bingo, you ring the bell, you take money off the table. That's my opinion of it, and you're overbought. When I look at XLK, the tech sector, okay, we look at this and we'll build the chart now together. You look at this chart, here's the swing line, higher lows, higher highs. So immediately you don't want to be short the market. I filter it with an 18-week moving average of closes. I'll put on a chart also typically the 100-week in green and the 200-week here. When a market is over the 18-week, the bias is up. So if you've got the trend up, you're looking to be a buyer in the market. What's one of the targets? I'm going to tell it to you again, the upper Bollinger Band. What did you hit today? Bingo. When you were long here, what did you do? Out right there. And if you look at the momentum, if you're not embedded, you're fully out. So in this case, the way I teach charting, I would have told traders to be fully out of the market. That is not being bearish. I could leave money on the table with what I teach them. It's possible. Okay? I'm not looking for the absolute high and low. I'm looking for the fillet out of that piece of cattle that you've given me. Lower highs, lower lows. The 18-week average is often the line in the sand. It's the DMZ zone between bullish and bearish. When the market's over it, That means the bias is up and you're looking for ways to be long. In this particular market, should this week you take out last week's high of 2608, I think the bulls will jump on the market. Momentum had been pointing down. It's no longer overbought. It's back to more neutral. Anytime you're under the 70 levels, you're not overbought. So momentum is down, but that would trigger me at least thinking, aha, I think you're going higher, possibly 2750. In the XLI, you have a downtrend that went back to that line in the sand, held it. I don't see a setup here that can be bullish. If the market gets under 99.49 again, that keeps the bear going. And if it closes under 101.18, the 18-week average, then the bias is down, the trend is down, and momentum's down. I want to join the bears. That's the thinking that I have. In the energy sector, the trend has been up but overbought. Lots of resistance here. If the pros did anything, you weren't embedded. I think they came out at that peak. That's what I teach, and we'll see what the market wants to do, how it resolves it. SPY, I don't see a trend. I see a market that keeps fighting here. This low comes down, takes out that low. I don't know what to do with it, but here's one of the techniques that I use. You're looking here, and this was the week of June 18th, at an outside week down. One of the tools that I teach in my charting course is if you take out the high of an outside week down, the week after that it's made, or the week after that, you got 2 weeks to do it. I think the pros buy the market on a stop over that. Their stop will be right under the week's low here, and they're looking to see if they can get up to the closest moving average above the market or the Bollinger Band. That's the play I think is at work. Plus you have that embedded reading. So I think there's still bullish elements at work there. The emerging market ETF, the traders just, they keep fighting, looking for ways to make this work. It's been a difficult trade. Momentum is still down, and one of the numbers is over 70. Until they're both under 70, you're overbought. Nothing on this chart interests me from the long side. If the market breaks under now 78.43, I could get lower highs, lower lows. Any settlement under 78.70, I'd be looking for this, the lower Bollinger Band, with stops back over that high. But first you got to settle under that 18-week average on a weekly basis, not intra-week. In the gold market, I think the pros have been selling the market right here at the 18-week, and I think they will throw in the towel if you hit 168.04. Then you've got a pattern that breaks the lower high, lower low. First objective, the 100-week average. If it keeps going down, the 156.16. The bulls are dying to give a reason to get bullish. Today was interesting. The market in gold was never really anything but higher all day. I kept watching it, and in my morning commentary, I said, I'm wondering if it's more the COVID, because this is before the jobs data came out. I said, what else can it be? Are they buying gold going into the jobs data? I didn't think that was the case. I think there's so much of this new Delta version that people are worried about. GDX is bearish. Lower highs, lower lows. First objective, 33.26, the 100-week average. You just missed it. You got to 33.30. You're pretty close, but you missed it. Momentum still down. You'd have to take out 35.18, a week ago's high, to negate the downtrend. AMC, short sellers came out, at least announced today, so the market's down $2. Did it do any damage to the chart? Well, here's the real pattern. You see the higher lows, but you also have lower highs. So you've stepped out of a trend. The resistance is going to be the upper Bollinger Band. On that band, you only 5% of the time stay over it. So one of the things I teach is that you can take each week over it and take away one of the percentage points of 5%. So this one, you got 4%, 3%, 2%, 1%, and bang, you're back under it. Does it always work? Nothing always works. It's a rule of thumb. It is not telling you to go short. It's telling you not to be long. Huge difference between the two. TLT, to say I'm surprised that interest rates are falling is an understatement. I mean, all we keep hearing on TV is why they should be going higher. First, it was going to be 2.25% at the end of the year. Now it's 2% from a lot of the people. But the market's not doing that. The market's cracking into the low 1.4s. And until the trend turns, not much you can say. Do I think the pros are coming out against this upper Bollinger Band? Oh, yeah. So the play's been made to the long side, but that's the resistance as I see it. In the euro, trend is still to the downside, lower highs, lower lows, a real lot of support. At 110.06 to 109.86, I think it gets anywhere near those numbers, the pros will cover their shorts, and I think that the pros also will pay attention to 111.91. If you take that out, you break the pattern of the downtrend. Last, we're looking at corrections that have been happening in DBA, which is the agriculture fund. And that's where you're getting all this super cycle talk about the ags and what they're doing. This is primarily the grains. And all you've done in a downtrend is come back to the 18-week average, and you're fighting a battle there. We'll see how it plays out. You know, twice a day in the morning, and I'm talking at 5:40 first and then at 8:40 in the morning, I start with a futures video. In it, I start off every day with the idea that you're looking for ideas on trading in the market. I'm going to cover first the fundamentals, the economic data out of Asia, Europe, or the U.S., what major U.S. reports are coming out, what the market's looking for and expectations. Then I'm going to start you into the charts, and they're going to look like that. So what's happening here is I'm going to teach you the different techniques. You'll notice there's more lines. I'm going to be using window envelopes in there, a few more moving averages. But there's only 5 parts that I teach. And moving averages, slow stochastics, Bollinger Bands, window envelopes, you're pretty much there. I will cover in the futures in this exact sequence all the time, the charts. There'll be a scroll bar that you can take right here if you're on the website, and it'll say metals. Scroll further, interest rates. So you drop it where you want, or you listen to the whole video. I do the same identical thing in the ETFs, 40 charts there, and I cover them in this sequence the same way. I know that most people don't want to go through 20 charts at a time, but I don't know if you're looking at energies and your neighbor's looking at stock indices, the other guy wants the interest rates, and some of them want XLKs and everything else. I cover it all that way. And I cover a lot of times both, as I said, 5 days a week, daily charts, but I'll bring in a weekly every now and then. And on the weeklies, on the weekend, sometimes I'll bring in a daily so you can see where the entry spots are as I'm at least seeing them and what I think you should do. And that's the difference. In these videos you're watching right now, I'm very generic. I am not generic in my paid subscriber. Buy here, sell there, straight stop, be out on a close on a basis under this, profit objectives, my thoughts. You get paid to be specific, not generic. On YouTube, it's free. So if you're interested, go to our website under the word research. It's there. If you want to look at our trading courses, they're under education. I'm Ira Epstein. Enjoy your holiday weekend. I'll see everybody Tuesday afternoon again. Take care now.